Welcome, everybody, to the Chinchilla Pickin' Podcast. It is November 23rd, 2021. My name is David Underwood, and I am here, as always, with Brandon Beaver. We always hope to be entertaining, educational, uplifting, because we want everyone to make money. Brandon, how are you, man?
I'm good. How about yourself?
I am actually doing fabulous. I'm worn out today, but I am actually feeling fabulous, doing fabulous, feeling good. I know my weight loss is not going to happen right now during this time, but we're going to try to stick with it. I've, struggled with that. And I just found out Brandon Beaver, guys, I've known this guy for over 10 years, and I just found out today that he's a fan of horror movies. So,
yeah, I love horror movies.
To each their own. To each their own. I'm more of a sci-fi fantasy guy, but, whatever. It all works. It all works. What do you like about horror movies? Just real quick before we get into the show.
I don't know. It's just scary. I like the Hills Have Eyes, the remake of it, Texas Chainsaw Massacre.
Jeepers. Isn't there like 5 remakes of that? The Texas Chainsaw?
Well, there were sequels, and then there was the reboot.
Gotcha. All right. Fair enough, man. Fair enough. We like what we like. And that's what makes us all special and unique, right?
And the recent Saw movie wasn't that bad, actually. Spiral.
All right. Look, man, I know we're not here to give critics on movies, but Saw was just all right. That movie, there was no point to it. There was no. I didn't get the storyline. It was just gory for the sake of being gory, and cool. It wasn't good.
Well, the new one, Chris Rock was the star in it. He was the lead.
But was he like the killer clown guy?
No, he wasn't the killer. He was the lead detective trying to find the killer. And Sam Jackson was his dad, Samuel L. Jackson.
I would have rather had Chris Rock as the killer clown guy. That would have been cool. I thought he would have been good for that.
But he actually did pretty good in this. He was pretty serious. Parts of it were cheesy, but
yeah, you got. I don't know. I'm not a fan of Saw. Oh well, maybe we'll get some DMs and messages about that. We'll see, right?
Right.
Anyway, we're here to talk about stock, man. It's the Tuesday before Thanksgiving. You had that short day on Friday for stock trading. Got all kinds of cool stuff heading up here. You got the holiday happening. We're gonna see these Black Friday numbers and Cyber Mondays and holiday specials actually add up.
I hate these short weeks. They're so boring. I like the holiday, don't get me wrong, but I hate the fact that the market's closed.
You just want the market to be open all the time because you enjoy it that much.
I need a break.
I do too. I enjoy the market. Don't get me wrong. I would love it if it was flowing 7 days a week, but I mean, come on, man.
Yeah.
Got to give people some days off.
Yeah, we're now at the point where it's basically trading from 7 a.m. to 8 p.m.
Yeah. Pretty much. I mean, pre-market, aftermarket's really, really busy. I don't, it still goes constant all day. Anyways, guys, if you've listened to our show for any bit of period of time, you already know the rules. Let me go over them one more time. Brandon and I get together 5 to 10 minutes before the show, and we tell each other what we're going to talk about. We saved a live discussion for you here on the show. And as always, we decide who gets to go first. Brandon Beaver's going to head us off, man. Take us away.
Both Best Buy and Dick's reported earnings today, and both stocks dove after the reports were issued. Dick's rebounded, though. Dick's was down about 11% at one point today, and it rebounded to being down only 4% by the end of the day. Best Buy had dropped at one point to almost 16%. And it's had a very small rebound to being down 12% at the end of the day. The fears for both of these companies were very similar. The fears were, have we seen peak earnings? We know Best Buy was a beneficiary of the work from home environment, everybody buying the computers to try to work from home, everybody updating their appliances in the house because they were staying in the houses more often. Best Buy got this. Well, they weren't open, but they got to stay open for appointment during the shutdowns, and they had a lot of online sales as a result as well. So there's concerns there that we've seen Best Buy peak. Dick's has been a beneficiary primarily of number one, the reopening. Team sports are back. So you're buying the jerseys, you're buying all that stuff. Kids are playing football and baseball again. So they're buying the cleats and all that good stuff. There's also been a shift towards outdoor as indoor events were canceled. So fishing, hiking, all that good stuff that people love. Plus, with Dick's, you've had a shift in consumer mentality to a more healthy lifestyle driven primarily by COVID-19. So the question is have these companies peaked? Best Buy is now at $121.27 a share. That's only up 0.88% in the past 12 months, but they had a big surge because of COVID-19 and the stay-at-home environment. In the past 5 years, Best Buy is up 170%, mostly because of the COVID-19 situation. Now, in the past 12 months, Dick's is up 128.98%, only up 131.34% over the past 5 years. Similar situation with those stocks. There's tailwinds that are pushing these companies that people are starting to get worried that they're going to start to kind of fan out a little bit. Okay, so let's dig into the earnings here. Let's see which company do I think had an overreaction to the downside? Why did Dick's rebound and Best Buy didn't? And which company, if you put a gun to my head, which company would I say to buy today? Now, Best Buy reported quarterly earnings of $2.08 a share. This beat estimates of $1.91 a share. That's another important thing. We should talk about this for just a second. Both companies reported earnings this morning. Both companies beat on both the top line and bottom line, and both reacted negatively. Okay. So Best Buy beat $2.08 per share is what they reported. The estimate was $1.91. The company reported quarterly revenue of $11.91 billion, which beat the estimate of $11.56 billion. Part of the reason why we're actually worried about decelerating growth in both of these companies is that you've seen decelerating earnings per share growth over the past 5 quarters for both of the companies. For example, Best Buy EPS for quarter 3 2021 was $1.90. For quarter 4 2021 was $3.46. EPS for quarter 1 2022 was $2.24. Quarter 2 2022 was $2.95, and this quarter 3 2022 $2.08. So you see the decelerating earnings growth, and it's been a little choppy as well. Now
I think you got your years wrong there, bro.
No, right now we're actually in quarter 3 2022 for Best Buy.
Okay, all right, yeah. Never mind.
Yeah, $2.08 was the EPS for this month, this quarter. I mean. Now EPS generally peaks in the holiday winter quarter seasonally for Best Buy, which makes sense, of course. So you usually see that Q4 EPS is higher than the rest of the earnings per share for the other quarters. Gross profit. Go ahead.
Do you think it's fair to compare the earnings and revenue from this quarter to this quarter of last year? 2020 was an extraordinary year, and it was different circumstances that we hardly ever see. Do you think that that's really a good, solid comparison?
Only because of the growth that Best Buy saw in its share price during the 2020 year.
Yeah, but we all knew that it wasn't gonna last, that it was gonna come back down to reality.
Right. Which is what's happening now. That's one of the reasons why they had this 12% decline today.
So what was the share price at this time last year?
Only
that would be my next question, because I would want to know what the share price was at this time last year, and then see if it's comparable. Because if it's not comparable, I mean,
well, it's like I said at the beginning of this, that shares are only up 0.88% for the previous 12 months. So they're almost exactly flat as to where they were this time last year. And if you look at the stock price,
they should be lower based on everything you're saying, and based on the fact that we knew that they would have fewer sales and lower revenue because of after the 2020 pandemic is over, people aren't going to be buying as much. They've already bought some.
Right.
They've already stocked up. So that share price should be lower.
Right.
Should it not?
I don't know if it should be lower, but I would call this fair valued.
Fair. Okay.
I would say fair, if anything.
All right.
That's all.
Sorry to interrupt you. I just don't think.
Okay.
I mean, comparing it to last year is. I understand we have to compare it to something.
Well, no, it's not only the reason why we're comparing it to last year is because last year's earnings were already built into the stock, and there's no way that those earnings, I don't think they can continue.
Okay.
So
yeah, I agree. I agree with that. I agree with that conclusion.
121. That's why we're sitting at 121.27 rather than where we were in January of 2020 around the $85, $86 mark. All of these things that happened in COVID got priced into it. The work from home, the updating of home appliances, 5G cell phone cycles, all that stuff I think has already been priced in, which is why we've seen the stock move pretty much sideways since November of last year. I talk a lot about margins here, and we talk about like why these are important. We want companies that are able to eat inflation. And
Best Buy doesn't have big margins, do they?
No. So we want to pass on the prices to customers. We want to be able to protect the company, protect our margins from inflation. Gross profit margin for Best Buy is 23.5%. It's not very high. Average for the industry is 21.86%. Me and you were talking about this last week and probably the week before and probably the week before that retail often does not have high gross margins.
No, they usually have like one or two higher price items that they try to push that are the high profitability for the company, and they try to really push those.
Right.
Like a lot of furniture places will push couches and sofas because the profit margin on those is very high for the company.
Yeah, it can be. Net profit margin for the quarter, 4.18%. I talked about last week about how net profit margin, it calculates SG&A costs and wages and all of that stuff, wage increases. And that's one of the most important indicators of retail. 4.18%. The management of the company has been doing what they can with what they have, and they've been doing pretty well. Return on equity, which measures the efficiency of a company, it's around 60%. This is important because one of the reasons why Best Buy has been on such a tear for the past 5 years, return on equity has grown. It was negative from 2012 to 2013, but it's continuously grown since and pretty exponentially. So at 60% right now, it's a pretty good number. It shows that management's doing a good job with what they have. Price to earnings ratio, currently at 13.9%. That's not too terribly high for where the stock has been trading at over the past several years. Let's look at the headwinds and the tailwinds. Headwinds, delay of supply because of the chip shortage. Now, one of the things that I noticed about Best Buy that piqued my interest negatively is that 60% of Best Buy's products are manufactured in China. That means lots of tariffs.
Lots of tariffs and probably some supply issues right now.
So yes,
I would imagine.
Got the supply issues from China. You've got the high tariffs on top of inflation, and they have stiff competition from Walmart, Target, and Amazon. The tailwinds have been work from home, like we spoke about, replacement cycles of tablets, home computers, and cell phones.
I wonder if all these big discounts they have going on certain products, if those products are just the ones that they have in stock and they're trying to get you in the door or onto their website with these big discounts on the ones that they know they have inventory of.
Yeah, and this is another thing too. They mentioned that inventory was up year over year. I think they said like 11%, which is similar to what Walmart said. But then it's not a hard comparison to say inventory's up year over year. It was very low this time last year as well. And the question is what what do you have in stock? Of course, you don't have the new consoles in stock, which is what everybody wants.
Well, I mean, and here's my question, and this is again, why are we comparing to 2020? Can we compare all of these same numbers to 2019?
That I agree with. That I agree with. When we move forward, we get into Dick's. They do comparisons to 2019. The only reason I was comparing earnings per share was because Best Buy got to stay open for appointments, and they were a big beneficiary of the work from home situation. And that was the reason why the stock moved as high as it did, was those earnings per share numbers from 2020. And then people now are concerned, one of the reasons why the stock dipped so far down today, that earnings per share growth has decelerated, and that we're starting to see Best Buy taper off and growth taper off. The concerns were, you see all this growth that we had in 2020, now it's decelerating, and now have we peaked? Despite beating the top and bottom line, and I think they said they had record Q3 numbers, which a lot of CEOs say that they can pick something out and say, we did this,
Right.
record gross profit and whatever international sales, and then say we had a record Q3. But the question is, has it now peaked? And I would not bet on Best Buy at this point, despite the fact that it's down and flat for the year. It's down for the day and flat for the year. I wouldn't bet on it.
Gotcha. And do you think, all right, so as everybody moves to a more mobile shopping through their phone and online shopping in that regard, and less in store, I mean, I know they've talked about this with Best Buy for years, because Circus City went out and disappeared, and Best Buy hung around, and everybody thought Best Buy was going to disappear, and then all of a sudden they turned it around and started making money and were profitable again. And so, I mean, again, we have to ask the same question: is Best Buy going to be able to continue with this? I mean, they really push their online order, pick up in store, or we'll bring it out to your car if you just park in the right spot system. They really want to push that system for shopping, and it's just a hard sell, because if you're going to go to Best Buy, you want to go in and walk around and look at things.
Yeah, it's I mean, the store's always been nice. They do great remodels at Best Buy. They make it look really presentable, really slick. Fanning the flames of the fears of peak growth, they guided comparable sales growth for Q4 of negative. This is a range of -2% to only 1%. So to me, that's telling me we've peaked, at least for the short to medium term. If your Q4 growth, which is usually that's the quarter that you bring in the most amount of revenue. And if you're looking at growth between -2% and only 1%, you're saying you peaked.
Right. And also, well, you got to also keep in mind too that we dogged retail last week here on the show.
Yeah.
And now you're looking at retail, and my question, I mean, are you saying like buy? But obviously you're not saying to buy on Best Buy, and I would say not a buy on Best Buy. I would stay away from retail still, because of the uncertainty of pulling forward sales. We don't know if people have any more money left to buy come December,
Right.
or if we've seen all the sales we're going to get.
Let's move into Dick's, because there was some surprisingly good results from Dick's Sporting Goods. Now, I think we all thought Dick's was going to have a good quarter, but there were some numbers here that were surprisingly good. So Dick's reported third quarter FY21 sales growth of 13.9% year over year to $2.7 billion, beating the analyst consensus of $2.49 billion. Adjusted earnings per share of $3.19 beat the analyst consensus of $1.95. So huge beat there. The question is presenting itself again. Have we seen peak earnings? Q3 2021, $1.84. Q4 2021, $2.21. Q1 2022, $3.41. Q2 2022, $4.53. Q3 2022, $3.19. And now we're at the EPS of $3.19. This is actually Q3. Sorry, I just said that. But I know, like I'm saying a bunch of numbers right now. If for some reason you were at home and writing this down, you would see decelerated growth. And that's the important part. Yes, we have growth, but decelerating growth. And that's what made this stock go down today as well. But there are some reasons why it rebounded. Earnings per share for Dick's peaked seasonally in the summer quarter. Same store sales increased 12.2% on top of a 23.2% growth from last year and 6% increase in Q3 of FY19. E-commerce sales increased 97% compared to quarter three of 2019. And still an increase of 1% from last year. The gross profit margin expanded 354 basis points year over year to 38.45%. If you're expanding your margins in this environment, you're doing a good job. Operating margin expanded 508 basis points to 15.3%. Operating income for the quarter rose 70.6% to $419.8 million. You want to look at valuations too. So the company doing great, that's awesome. But where's the stock at? Price to earnings ratio right now is 11.7%, which is about average considering where Dick's usually trades. Now, when I say it's about average, I'm completely discounting the COVID pandemic and what that did to the price to earnings ratio, because the COVID pandemic really did some weird things to PE ratios over that period. So we just completely ignore that. Okay. Gross profit margin came in at 38.45%. Net profit margin, this is the important one, 11.52%. So more than double Best Buy's. I think this is one of the most important things. And I think this is the reason why Dick's rebounded today and Best Buy didn't. Expanding margins. Now compare this to the same quarter in 2019. Net profit margin in 2019 in Q3, 2.93%. So huge growth there. Return on equity for the stock's around 46%. That's phenomenal. It's a little bit lower than Best Buy's, but it's still great. Return on equity has been steadily rising for this stock since 2017, discounting the COVID shutdowns. Now,
sounds like it's a good stock, man, so far.
Yeah. And CFRA, the analyst organization that I respect next to Morningstar, they're the only two companies that I really pay attention to when it comes to stock prices. Today, they raised their opinion on shares of Dick's Sporting Goods to buy from hold. They increased their 12-month price target by $50 to $190. Now, that is pretty rare to have a stock decline 4 to 5%, but have an analyst increase price target. Usually,
well, hold on. No.
They'll reiterate a buy, but then lower their price target a little bit to match expectations.
Okay, all right. Yeah. That's rare.
Yeah.
I thought you were saying something else, and then you just reset it again and restated it, and I caught it that time.
Yeah, so they'll restate their buyer rating, but oftentimes they lower the price target because they want to be as accurate as possible. But the CFRA is actually raising it by $50, and they said they're doing it based on 13.7 times their FY23 EPS estimate, and that's in line with the company's 5-year average forward PE ratio. Now, headwinds for Dick's: direct-to-consumer efforts by Nike and other key vendors. Tailwinds: the COVID-19 inspired shift to healthy living. And Dick's it's built a very small competitive moat, partially through specialty stores that they own now, like Field and Stream and Golf Galaxy. But it's still a relatively competitive area here. They have competition with Walmart and Amazon and Bass Pro. So it's still a heavily fractured area, but they've done a good job of insulating themselves as much as they can.
So this winter, Dick's will probably do well, January and February. Here's why. What happens this next February? Winter Olympics.
Oh, yeah.
Anytime during the Olympics, And the Winter Olympics, ski resorts do very, very well because everybody wants to go out and think they're the top notch skier and go out there and win a gold, because who doesn't, right?
Right.
I could be a downhill racer. And so ski resorts do well. Specialty sports stores that specialize in skiing and snowboarding typically do well because people will go out there and buy some gear, maybe not top of line gear, but they'll buy some of the lower cost, lower end gear, and that will help out a lot of these places during the Olympics. Sports related industry that compares to these events, what does see a boost? They do see a boost every single time. It's pretty consistent.
So when I tell you that I think Dick's is actually a little undervalued right now, you may look at the 1 year chart and say, wait a minute, Dick's is up 128%. Best Buy is only up 0.88%. You're telling me to buy Dick's instead? Well, look at the price to earnings ratio. The price to earnings ratios is relatively low at around that 11% mark. The return on equity is good. It's a little less than Best Buy, but that net profit margin is the most important thing. The fact that they can have expanding profit margins in this environment speaks volumes to management, and it justifies this increase in the stock price. And I think it's actually undervalued right now. I think we're going to outperform on Dick's in the next year as long as market conditions warrant it, as long as we don't have a recession.
Exactly. So, I mean, I forgot the point I was going to make, but yet I agree with you is the point I was going to make. Dick's is definitely undervalued. And I was going to bring up NVIDIA. When you talk about a stock that's up 120% right now year over year, when you make the call to buy it, look at when I made the call to buy NVIDIA. That chart looked like it was at its peak in history, and it was, and I still said it's going to go higher. Yeah, and it did. So just because a stock is at its all-time high doesn't mean it's not going to go higher. You just got to have good research and reasons for that. And exactly, you did your research, you did your reasons. There's multiple reasons. You didn't even think about the Winter Olympics either. Is that a possible reason for a small little tiny boost? But every little bit helps when you're looking at a stock.
Yeah, and they expanded their margins while adding 9 new stores this year.
Come on, man. I love a company that can expand their margins during a time like this, and especially during inflationary times when a lot of people are having to lower their margins in order to stay competitive.
Mm-hmm.
I mean, if Joe's sports shop down the street is selling the same shoe for $20 less, I got to compete, man.
Right.
I got to lower the cost of my shoes, and if my margin's like at 2% and Joe's is at like 20%, Joe can eat that. I can't. I'll be out of business, and then he'll own the business, and then he'll just raise the price of shoes again. Yep. And that's how it works. So at least that's how Massa thought it worked when he bought Sprint and tried to take over the market here in the U.S., and it didn't work out that way for him. But, oh well.
Yeah.
Doesn't always work the way we think,
Right. And the charts, the one year graph of just the price chart, that's just one part of the story. Valuation indicators, I think, are much more important, like the price to earnings ratio, price to book, and all that stuff. And I
love a good PE ratio, man. I love good PE ratio.
Yeah. And then beyond that, the return on equity. What are they doing with the money that shareholders have given to them?
Right. And that goes back to, and that goes back to like, if you're not profitable, that's fine. But like, what are you spending your money on? How are you reinvesting this money? Why are you not profitable? Where's it going?
Which is why I have to say Best Buy's management's been great, but the industry that they're in and what they sell, it doesn't, to me, really work very well in an inflationary environment.
Yeah. And they sell a lot of discretionary items. And if we move because of heavy inflation, I mean, I shared in our chat here on this video, the people at home cannot see him, but Goldman Sachs, the head of Jamie Dimon, the head of Citi, was going out there and saying, hey guys, if inflation continues, we might be going into a recession or a depression, and they have a drastic effect on the global economy. Yeah. Both of the heads of those companies came out and said that. And so you got to ask yourself, is this a company that can withstand a recession? And if you sell a majority of your products are discretionary items, that's going to be hard to stay afloat during a recession or depression.
Right.
And we are eventually going to have one. Our economic system is built on business cycles. So eventually we will have a recession of some sort. Hopefully it's a small, light one, and we get through it and out the other side very quickly. But if you're running margins tight and you're just barely getting by, you're not going to last, man.
A real recession, because a lot of people might listen to this and say, well, we just had one because of COVID-19. But it wasn't a financial recession.
That wasn't a fun. It had nothing to do with the
business cycle.
financial markets or the economy. Yeah, that was just a strictly health induced. It was a recession, but it wasn't a real recession as we look at it, who watch the economic data and economy year over year.
Yeah, and you have to be defensive about it. You're defensive because you're in and out.
Yeah,
you get in stocks, you get out. I use a portion of my money to do the same thing, and I have some investments on the side as well. But I'm always really defensive with my investments too, which is why I came up with a checklist that we put on chinchillapicking.com. That's why I focus so much on the profit margins and the net margins and the return on equity and all that stuff, because I want a company that's going to be able to survive the next recession that we have. And it's also why I moved all of my account from Robinhood to TD Ameritrade, because if we have a recession in the next 2 years, I think Robinhood's going to have a problem with surviving that. So that was a defensive measure on my part too.
Yeah, I think Robinhood's going to have a problem surviving that as well.
Yeah,
I mean they're not set up to withstand all pressures from every angles, and especially if the federal government rules that the way they make money, the majority of the way they make money is going to be taken away.
Yeah, you go back into a TD Ameritrade, which would operated prior to payment for order flows just fine.
Yeah, exactly. Because TD Ameritrade has so many other issues and other ways of making money. So that's definitely it's a smarter way to put it.
That's all I got for today.
Really?
Yeah.
Oh man, I thought you had a lot more than that. I mean, apparently I wasn't paying attention pre-show. That happens. Sometimes I zone out. It's okay. So, all right, let's go into what I got here. I'm going to talk a little bit, guys. I want to discuss this just for a minute, and I'm not going to get into politics. I don't want to get into. I want to stay in the stocks, right? How do we make money? How do we invest? What do we do with the information that we have and given to us? So earlier this year, I had pulled up, I have my notes here, and I was talking about oil rigs. So everybody was saying that supply was going to be low, supply was going to be lower, and oil, and thus because of that, the cost of oil was going up. And I was like, why is supply low? When I was looking at the rig counts pre-COVID, I pulled up the numbers. I looked at the rig counts then. That's the oil rigs. And it was like 700, right? And then I pulled it up back in May of this year, and it was like at 750. So we had more rigs. It was great than what we did pre-COVID. Then all of a sudden, it jumped down just 1 month later to like 400. And I was like, well, what happened? And I went on, we talked for about 15, 20 minutes about what happened here. I don't understand what's going on. Why this is happening? I don't get it, because the cost of a barrel was going up. These oil companies' stock prices were not going up. They were, in fact, some of them were going down, and I didn't understand that. Yes, it was just slight moves, 1% moves, but they were trending downward. And I said, this is not right. Something's not adding up here, right? And what I ended up finding out was during that time, the current administration went ahead and canceled all these oil rigs, in either their, what do you call them, their licenses, if you will, or when they filed the paperwork, say, I want to drill in this location. Here's all my paperwork. Here's all my safety precautions. Here's all the contracts, blah, blah, blah. Here's what we got. I want to drill right here. So the oil companies did all this and they filed correctly, but then the current administration said, nope, denied them all. And so all of a sudden the oil rig count was dropping. There was less oil rigs going out because of this move. There was less oil rigs Thus, the supply of oil dropped down low. And then OPEC had to step up. If they eventually at the end of summer they did, I believe it was like August is when OPEC started pumping out more, and then that really helped the economy as well. But at the same time, the cost of oil kept going up and up and up and up, and the stock prices weren't seeing it. And the reason why the stock prices weren't seeing it is because the big companies like Goldman Sachs, JP Morgan, those people who had contacts inside the government understood that these oil companies they weren't drilling anywhere. So they didn't have any oil wells. And I did not know that at that time. I did not know that nobody was drilling new wells. And because I looked at the rig count, I said, we have enough rigs. And, I know they're filing paperwork for this, but they weren't getting approved. So because they said there's no future prospect. So let me explain this a little bit easier for people to understand. So say BP, right? Or Shell, whoever, ExxonMobil, we'll use them, right? Mm-hmm. They got 20 rigs, oil wells right now in Texas, the Permian Basin. They're over there and they're pumping out the oil and say the oil is going to last 2 more years. Well, if you don't allow them to find new wells and open up new wells and rigs and what have you, and then when those wells dry up, they don't have any more profit stream, right? They don't have any more revenue coming in. So now it's not a good company to invest in. So JP Morgan, Goldman Sachs, all the companies that knew this was that the administration was going to do this was not buying the oil companies, even though the cost of oil was going up. And I was perplexed because I did not know that was the case, that they were just getting denied everywhere, right and left on new wells and new rigs. But now that I know that, I see that. And now that I see these oil companies the past couple of months actually jumping up in price, it tells me maybe the administration has changed their mind because now money's flowing into these oil companies. Now the stock prices are actually reflecting more of what the cost of this per barrel is. So maybe now they're actually getting approved for new wells and new rigs again. And they already have the equipment ready to go. They already have everything set up. They just were denied back in May. And that's why you saw the huge drop by half the amount of rigs from May to June of this year. And so in saying all that, are the oil companies a good buy right now? Right now, I would say you could swing trade the oil companies. Are they a buy right now? They just gapped up the past 2 days.Maybe wait for a chance to get in off a quick dip. We never know what's going to happen, especially on these shortened weekends, these shortened weeks. And the Friday after Thanksgiving is always a little weird. Usually there's some movement in retail, but that's about it. You have a very low volume on the Friday after Thanksgiving because it's a short day. And it mainly, like I said, mainly the focus is in retail. You might see the oil companies might be a good buy going into that. And especially if the numbers come out well for Black Friday and retail stores over the weekend, you're going to say, hey, the economy's back and rolling. Boom, oil companies are going to shoot up because we're doing well. And now you're going to use more oil because we have to ship goods. So that might be a play right there. But that's something to think about. And I want to put that out there as something. When you see something that's unusual and you can't figure out what's going on and all the numbers point to like, hey, we should have these rigs opened up. This oil company should be valued higher. I don't understand it. When you see that keep asking questions because something is going on that we just can't see. And in this case is the administration was cutting all the approvals for them. Whether or not that's a good thing or bad thing, I don't know. I'm not going to argue that, but I just wanted to put that information out there so that everyone knew, because I didn't know and I was confused and I thought oil companies were a good buy back then, but I didn't know why it wasn't moving. So I pulled out my positions because I didn't want to lose money. I was like, something's happening. I don't know. So
my question here about this situation, given that there's going to be political pressure to bring down oil prices again, and then I think that the rise in oil prices, personally, I think it's going to be short-lived. I also think that the rise in oil prices has been largely priced into a lot of travel stocks, specifically the airlines. Delta's back to trading below $40 again. Does that present an opportunity?
For Delta, yes. For United, for United or American, no.
Right. And
For Delta, yes, because Delta's a strong company. They had a strong balance sheet. They were able to withstand COVID all on their own without help, but they took
exactly,
help anyways. Which means they're even having a stronger balance sheet now because of it.
which is, I mean, I've traded Delta because it's my favorite out of the group. But I've also traded it because I don't like being long airlines because it's a very competitive industry.
Yes,
Um,
it is. Yes, it
but it,
is.
it seems to be in the past year, every time it's below that $40 mark, it's a good buy. And then you
Yeah.
trade it back up to 45, which is a pretty large percentage, and then you sell.
And they're saying right now the holiday travel with Thanksgiving is going to be at pre-pandemic levels.
Yep.
So everybody is out there traveling. The airlines are staffing back up. All the people they furloughed or laid off, or everybody is back on board. Even Southwest rescinded their vaccine mandates so they could keep pilots in the air flying because they needed more pilots and more people flying. So they're even pulling back vaccine mandates to get airlines flying, to get airplanes in the air. So they're doing everything they can to get staffed up again.
If we're opening up new rigs and if we're pumping more money into the oil to try to get the prices back down at the pump, then the spike in oil prices is a buying opportunity for travel, I think, specifically Delta
Yeah.
Airlines and the airline,
Right. I mean, when the president released the strategic reserves, which is something we do in times of trouble, we have it there for a reason, and he released that today, so that's going to flood the oil of a little bit flood the market with a little bit of oil. So
yeah,
I mean, you have that going on as well. I don't know. I wanted to put that out there. Keep an eye on oil and these oil related stocks. It's definitely something to watch. It's always interesting with oil because it does get a little bit political, and that's because oil is a political item. It's a hot topic, and if you're trading oil stocks, you got to be aware of what's going on. You don't have to have an agreement one way or another, but be aware of it so that you can make the correct trade and make money correctly.
yeah.
I don't know. It's
The
my
two
2 cents.
things that he can do to combat inflation, he could, what he did today was release the strategic oil reserves, and maybe during the next meeting with President Xi of China, they can strike a deal to eliminate some of those tariffs on China. And that would be a big boon to tech.
Yeah, that would be a huge boon to tech. But I mean, my question is China gonna do the same for us on their tariffs?
I don't know.
Goes both ways, right?
Mm-hmm.
Anywho, that's our show for tonight. I do want to make a call, guys. Real quick, I am going to make one call. I know Cooler just took a big drop down. I still see it as an opportunity to get in. Back up the truck, pile in some more money. It's a great opportunity to get in because it's going to continue to grow. In fact, the only news I saw, I checked multiple news wires, and the only news I actually saw on Cooler after their earnings call was that someone raised the price target to 450. So I for it to drop tells me that's just people taking profit, which is right because it's not a high volume stock. So don't get in there thinking you're going to move like 20,000 shares in and out very quickly. No, this only moves about 1.5 million to 2 million shares a day. That's it. But I mean, it is going to move. It was a lot of profit taken, and rightfully so. Good for them. They took their profit. They made their money. Move on. But I'm in it for the long term. That's definitely one I'm looking at. As far as oil, I would wait. Like I said, they just had to gap up. Let me read some more news stories. I'll put a post on Instagram if I believe oil companies are gonna keep going up higher. But I do like Brandon's call or suggestion, if you will, not a call, on looking at Delta since it dropped below 40. That's something definitely to take another look at and do some research. Brandon, final thoughts?
Yeah, I'm not too concerned with decelerating earnings growth in Dick's as far as the past few quarters go, because the summer quarter is always the best quarter for Dick's, it looks like. So it's no surprise to me, but I am concerned with decelerating earnings growth with Best Buy. And so other two, definitely picking Dick's. I do like Delta below $40. And that's all I got.
That's all you need to have, man. You just need to have one good call, and every single couple weeks, and and you'll make money. And if you consistently are heading that 5% a week, week in, week out, you will accrue wealth over time. It just takes time. You have to be patient. It takes time.
In our competition, you did 5% in under 24 hours with Cooler.
Yeah, and I've done that more than once too.
Yeah.
So I mean, it's
So what's that bring us
fun.
to?
Day trading is fun, huh?
What's that? I wonder how I know we're up over 20%.
Well, for the month, yeah. I mean,
Sure.
easily. We're easily over 20% for the month. We're probably closer to 30, 35 for the month.
Yeah.
But here's the thing, guys. You're going to hear an update on that. We're going to have the guy behind the competition actually on the show for the first episode in December. He agreed to come on, sit with us and talk about it and talk about some of the pros and cons, some our one loss. We did take a loss on one thing. We'll talk about that loss, why we took it, how much of a loss we took, and how long it took to come back from that. But I mean,
it's only been one loss.
Only been one loss, and that's it. But I like to cover our losses because they hurt the most. You remember them forever, and we need to be transparent with everybody. Like, look, we're not perfect. We're really, really, really good, but we're not perfect. So we're gonna have some losses.
They happen. And then if you're good at taking losses, you limit your losses.
Exactly. And so
somebody told me a long time ago, it may have been you, I don't know though, I don't remember who it was, but somebody said one of the most important aspects of investing and trading is being good at losing money. That doesn't mean that you're like losing money all the time and look at me, I'm so great at it, I just lose money all the time. What it means is that you're good at limiting your losses.
Yep. Exactly. That wasn't me, but that's a good statement. I like it. All right, guys. As always, we hope we've been entertaining, educational, and uplifting because we want everyone to make money. Have a good night.
Have a good night. If you've listened to our podcast before, you know that we are good friends with the Money Vikings, and we think that they have a lot of good knowledge and, just a wealth of knowledge to offer. About 60 years worth of knowledge and trading experience between the three, between Greg, Bob, and Jerry. Now, I have some good news for you because they have announced a premium program. It's the Money Vikings MVP premium content. Okay, and I have to tell you this right now. If you are new to the market, you have got to have somebody to mentor you through it because 75% of all new market entrants will lose all of their money in the first year, and you have to have somebody that will guide you through it to prevent you from making these mistakes that most people do. And with this MVP access, this premium content, you will get direct access to Greg, Bob, and Jerry on Discord. That's the most important feature of this program, in my opinion. They do also have access, they will give you access to other things such as hot trades, weekly newsletters, technical analysis. Hey, it's ad free. That's cool too, right? Guides and tutorials, tools and custom technical indicators, exclusive analytics and informative articles, and then, as I said, exclusive direct access to Greg, Jerry, and Bob, who have over 60 years of experience between them. Now, if you listen to this podcast, you need to get a pencil and you need to get a paper and you need to write this down because you get 25% off. Once you go to moneyvikings.com and you sign up, you'll get to enter in this code. It's capital TMV P1CK1NS. That is all capital TMV P1CK1NS. An easy way to remember that is TMV Pickens, but the one replaces the I. So go to moneyvikings.com, claim your discount for being a chinchilla picking podcast listener, and conquer your financial freedom.